We had a decent red day on Friday. Many stocks were down 2, 3, 4, 5%. It was a bad day in my own portfolio in general. I was up 19% year to date. I'm still up double digits, but no longer 19%. And that's how the market is, guys. I always say sometimes you have good days, sometimes you have bad days. And I always say that everyone is a long-term investor until their stocks go down. And then you kind of realize if you're panicking, if you don't know what to do, then you're not a long-term investor. But to me, Friday was an amazing opportunity to not only buy some of my favorite stocks at a discount, which I'm going to share some of them today, but I also got to research potential buying opportunities that I could buy if the market continues going down. And it was a good day in general. I like what's happening. I'm going to share two stocks with you today that I believe are offering the best risk to reward in the market. They don't have the highest reward, but in terms of the risks you're taking versus the potential reward you could get with those companies, I like those two very, very much, especially the first one, which I'm going to talk about right now. And this stock is Google. Google right now is down 9% over the last months from all-time highs down around 12%. The stock's been getting killed. And I did talk about Google when it was trading at $207 per share. And I told you guys my fair value maximum is 185, but I really like Google around 175. Now it's getting close to 175, and I'm starting to like the company very, very much as a potential buying opportunity for me. But the best part about Google, or I should say Alphabet, is you're not only getting Google, you're also getting YouTube, you're also getting an amazing ad business, you're also getting Google Cloud, but you're also getting exposure to so many different things, like autonomous vehicles or robo-taxis, if you want to call them, with a company called Waymo. And Waymo has been killing Lyft in markets like San Francisco. As you can see here in the green line, it's been taking market share. It's going to surpass Lyft very, very soon. And that could be a very profitable business for Alphabet over the long term. They can even split it up in a different company. It would be worth billions and even tens of billions of dollars, especially in the current market for autonomous vehicles. And you're also getting exposure to quantum computing, where Google is a leader in quantum computing. And again, if they decide to split it up in a different company in the future, they can unlock tens of billions of dollars for long-term shareholders. So you get exposure to so many different things, all within one company. For revenues, last earnings report, there was a slight miss, nothing too bad really. Earnings per share, 2 cents beat. It was a good beat from the company. The market was worried about CapEx a lot, that Google is spending $75 billion in CapEx, but it's nowhere close to other players in the market like Microsoft, which is spending $80 billion, and Amazon, which is going to spend $100 billion in CapEx. So Google or Alphabet did increase their CapEx, but they're just trying to keep up with the other big six, I should say, or big five. They are spending tens and hundreds of billions in CapEx. So again, I believe the management of Alphabet is smart. They're not spending $75 billion on nothing. And they see an opportunity here, and they're trying to capitalize on it. So that's how I think about the CapEx. For Google Cloud, the growth has been slowing down, but it's still pretty steady. It's been steadily growing quarter on quarter. Profitability has been increasing quarter on quarter, and it's getting better in general. Now, the main concern with investing in Google or Alphabet is mainly ChatGPT. That ChatGPT is going to take over Google search, and then the search business or advertisement business of Alphabet is going to be obsolete, and this is going to be dead. And that's very possible. If you look at ChatGPT, they have now 400 million weekly active users, up 33% since December. It's now the sixth most used app, around 2.3% in terms of website, I should say, 2.3%. Google is still 29% in terms of usage, and it's up 2.5%. YouTube, which is also owned by Alphabet, is 20% of the traffic share and has declined pretty close to 1% months over months. And ChatGPT is growing rapidly, and it's of course a major concern for the company. I'm just being honest, but this is the way I would think about Alphabet. I'm going to give you two different kind of valuation models. The first one is a study from Barron's, and Barron's is a very well trusted. I like reading their articles for Barron's, and I did a lot of research on Google, and I decided to look into Alphabet in general and find out what could the separate pieces of Alphabet be worse if they decided to split the company? So if they split cloud, if they split YouTube in a separate stock, they split Google search in a separate stock, how much could it potentially be worse? And this is a very interesting study. Now, I read a lot of the calculations. Most of them seem very fair, but the one on Waymo was a little bit too optimistic, but I'm still gonna use it. Okay, now for Waymo, they expect Waymo to be worth $26 per share. When I gonna add $26 per share, Cloud, they expect $26 per share. I think it's a little bit higher actually. YouTube, they expect $65 per share. Now for the search platform, let's assume that ChatGPT is gonna kill search over the long term, or it's gonna even kill it right now. And search is not worth $143, it's worth $70 per share. So we'll cut off 50% of the search value of Google, and we add $70 instead of $140. In this case, we get a share value of $187 per share. Alphabet right now is trading around $181. So in other words, if you value the stock on separate pieces and you combine them together and you take off 50% of the value of search because of ChatGPT, you still get a higher price right now than you would get, for the whole company. And to me, it's insane. So the way I would look at it is that yes, ChatGPT could really kill the search engine, but there's so many different things that could potentially offset it. One of them is Waymo, could be extremely profitable for the long term. One of them is YouTube, and a lot of their other bets that could potentially work out. But I also believe this is also somewhat factored in valuation for Alphabet in general. And I always say that it's not just what you buy, it's also what you're paying for it. And I believe Alphabet here is reflecting a lot of those concerns that many investors have. Now we look at the PE ratio, it's trading out 19 times earnings. 19 times earnings, if you look at this line, it has historically been a good time to be buying Alphabet around 19.9 times earnings. The mean is around 23 times, and now it's trading close to 20 times earnings. And the way I would value something like Alphabet is they're expecting earnings per share growth to be between 12%, 14%, 15%, 13%. So we can expect 13% on average. Now, if you're buying Alphabet today at 19 times earnings, and if they grow earnings per share 13%, I would expect the return of Alphabet to be around 13 to 14% kind of annual return, excluding a multiple expansion. With a multiple expansion, back to 22, 23 times, it's very possible. In this case, I could see 15 to 17% annual return, or in other words, I see over a 2x in Alphabet stock over the next 5 years. Now, it might not sound like the highest reward ever, but if you could double your money with a mega cap safe stock like Alphabet over the next 5 years, with the companies they've been buying back so much stock and starting to do dividends, and they have around $95 billion of cash, to me, this is worth risk reward. Alphabet is looking extremely interesting at this price, and that's why I put it as not the highest reward, but in terms of the risks you're taking with the stock and the potential reward, I'm liking Alphabet very, very much, and I might start buying the stock soon. I've been finding different kind of opportunities in the market, but in terms of Alphabet, I'm starting to like it very much, and that's why I wanted to give you an update on it after I believed it was overvalued at 207. Right now, it's looking much, much more interesting, especially if it goes below 175, it starts getting extremely, extremely interesting for the company. Now, the second stock that I bought the dip on Friday is Amazon, and Amazon did go to around 214. I bought the 215 dip. I believe it was 215.20 or 215.30 cents, and in my opinion, that was a decent buy for Amazon, and I'm going to tell you why. Now, Amazon is down 8% over the last months. It's down from all-time high around 10.5%. So it's pretty interesting. And I know a lot of you guys are going to say that, yeah, but if you zoom out on Amazon, it's up 100% over the last 5 years. And a lot of people on X, they told me, I'm waiting for Amazon to go to $150 per share just because they saw it at $150 like a year and a half ago. So they believe they're going to buy it again at the same price. And I talk about this a lot, and it's mainly price anchoring. But if you see a stock at a specific price, you cannot pay more than the price you've seen it at, despite the change in fundamentals. So yes, Amazon used to be worth $130, $150 in 2023. But in 2023, cash from operations is up 81% versus 2022. In 2024, cash from operations is up 36% from 2023, and from 2024 to 2023. So the question is really Amazon gonna go back to $150? It's possible, but it's not just about the price that has changed. The fundamentals have improved with the price. So I don't believe Amazon's going back to 150. And I believe the bar is a little bit higher than what most people are willing to pay for Amazon. And I believe 216 was a fair price, and 215. I'm gonna tell you why. Now, for trailing 12 month sales, the company increased it 11%. Amazon Web Services still going strong, a little bit decelerating, but still going strong. Operating income is up 48% year on year for Amazon Web Services. I'm gonna try to keep the video short, but cash from operations has been massively expanding quarter on quarter from 84 billion, 99, 107, 112, 115. But they've been spending so much on CapEx, a lot on CapEx. Some of it is permanent due to the infrastructure and distribution centers and the freight business and all these kind of things. So they have to spend some CapEx. But most of it, in my opinion, is due to AI and due to many different projects that they're making that I believe they could somewhat pull back anytime, or they can slow it down. So that's why you're not seeing a lot of free cash flow from Amazon. Like in Q4 of 23, free cash flow is 36 billion. Now it's only 38 billion, while cash from operations went from 84 to 115. But they're spending a lot of it on CapEx. The company does make a lot of cash from operations. This year, they're expected to make $142 billion in cash from operations, but CapEx is 99 or almost $100 billion. This is a lot of CapEx, and the company is increasing AI stuff. And as you can see over time, as CapEx stabilizes around $100 billion, hopefully it does, free cash flow is gonna look much, much better. I could show you the picture here. So now free cash flow for 24, it was 38 billion. This year is expected to be 50 billion, 2026, 75, 109, 124, $154 billion by 2029. And a lot of smart people that own Amazon told me that it could be even in 2028. And it's very exciting. So the way I would value something like Amazon, I would take the $154 billion of potential cash flow 5 years from now, which is in 2029, and I look at the market cap to free cash flow multiple. It's trading at 45 times free cash flow, which I believe is a little bit extended. And for this valuation model, I'm going to be more conservative. I'm not going to use 45 times cash flow. I'm going to use 30 times cash flow, which is a massive multiple contraction. Even though over time, those companies, as their moat widen, as the company becomes more profitable, they get a multiple expansion. So I would not be surprised if 45 times cash flow holds up over the next 5 years. But I'm going to use 30 times cash flow to be a little bit more conservative. Okay, and we take the $154 billion in potential cash flow by 2029. We time it by a 30 multiple. This is a $4.6 trillion market cap over the next 5 years. And we divide it by the current market cap of around $2.3 trillion. We get almost a double over the next 5 years, or 15% a year, with a company like Amazon using 30 times cash flow, not the current 45 times. If I use 45 times cash flow, or even the current of the mean multiple of 39 or 40 times cash flow, it could be even a double, or it could be a triple or a quadruple over the next 5 years. So on the low end, I'm seeing at least 15% annual return on Amazon. On the high end, 22%. I'm leaning more towards 20%, even right now at $216 per share. If the stock goes lower to 100 or below 200, I'm going to be a buyer. I've been averaging up on the company. I bought it in the 160s, 170s, 180s, and I've been averaging up. But I still see at least a double over the next 5 years, but I personally believe it will likely be much, much higher than the double, potentially a triple over the next 5 years with a mega cap, amazing wide moat company like Amazon. So that's what I'm seeing in the market. I think both of those are presenting, decent opportunities. A lot of people are gonna wait in case the market goes lower and are gonna miss out on those stocks just like they did before. And I know how it works, and I'm not trying to time the market. When I see good value, I buy a little bit. If it goes lower, then I buy a little bit more. That's how I've been doing it, and I'm gonna continue doing it. So now, financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.